Good morning. This is X-Pulse AI Morning Mix. Today is Tuesday, May 5th, 2026. We're digging into OpenAI's new $10 billion enterprise push, big tech budget whiplash toward AI infrastructure, and where fresh capital is flowing, from agents to robotaxis. I've got Orion with me. Ready?
Ready. Let's do it.
We're leading with OpenAI. What happened?
Bloomberg reported on May 4th that OpenAI finalized a roughly $10 billion joint venture with private equity and asset management firms. Names mentioned include TPG, Brookfield Asset Management, Advent, and Bain Capital to help businesses deploy OpenAI software.
So this isn't just more funding. What is it structurally?
It sounds like a deployment machine. Pair OpenAI's models with capital, implementation teams, and go-to-market channels that finance firms already have. In practice, it can bundle software, services, and spend. Think model access plus integration plus change management, so enterprises can move faster.
What changes for buyers if this works?
Procurement gets simpler, and adoption gets more packaged. But it also nudges the market toward a few big standardized deployments, less tinkering, more turnkey. If your pilot has been stuck in PowerPoint, this is OpenAI trying to unstick it with a very large checkbook.
Now, the messy part of the AI build-out, jobs. What are we hearing from Meta and Microsoft?
Crypto Briefing reported on May 3rd that Meta Platforms and Microsoft cut a combined roughly 81,000 jobs in the first quarter, described as a reallocation toward AI infrastructure. More data centers, more chips, more capex.
That number is huge. How should listeners treat it?
As reported, not fully corroborated in that write-up. But the direction matches what we see broadly. Companies are squeezing operating expense to fund infrastructure. It's like trading headcount for megawatts, grim, but financially consistent with the AI arms race.
What's the practical implication if this pattern continues?
Expect more internal tooling automation, tighter budgets in non-core teams, and relentless focus on infrastructure utilization. When compute is the constraint, everything else becomes negotiable, sometimes painfully so.
Big money into AI agents. Sierra just raised nearly $1 billion. What's the headline?
The Economic Times reported on May 5th that Sierra raised $950 million at about a $15 billion valuation, with investors reported to include Tiger Global and GV. The focus is enterprise customer experience, using AI agents to handle service workflows.
For people who haven't tracked Sierra, what do they actually sell?
Think AI frontline for large companies, systems that can resolve routine customer requests, route complex cases, and assist human reps, often across chat, email, and call center operations. The pitch is measurable outcomes, lower handle time, higher resolution rates, and better consistency.
Why is this round landing now?
2 reasons. Buyers finally have budgets for agents that touch revenue, and investors like enterprise paths to distribution. Also, customer experience is a clear ROI sandbox. Nobody writes poems to the help desk. They want the problem gone.
Let's shift to the physical world. What's happening in autonomous vehicles funding?
Business Insider reported on May 4th that the autonomous vehicle sector drew about $19 billion in funding, concentrated among a few leaders. Waymo led the year with roughly $2.5 billion raised, with other big deals including Wave at $1.5 billion and Wabi at $750 million.
Concentration is the key word. What does that signal?
Investors are picking potential winners and trying to get them to scale. Robotaxis, logistics, and real deployments, not just demos. The economics are brutal. You need huge capital for fleets, mapping, safety validation, and operations. So money pools where there's traction.
Does this connect back to AI infrastructure spending?
Absolutely. Autonomy is an AI plus operations business. It's compute for training, but also sensors, vehicles, insurance, depots, the whole unglamorous stack. Funding follows whoever proves they can run that stack in the real world.
On chips, Nvidia's supply chain exposure is getting more concentrated. What's the report?
Tom's Hardware reported on May 4th that Nvidia's exposure to Asian supply chains for components rose to about 90% of production costs, up from roughly 65%. The story points to deeper reliance on suppliers like TSMC, SK Hynix, and Samsung.
What's driving that jump? Just more volume.
Volume, but also complexity. As Nvidia pushes further into what it calls physical AI, the bill of materials and specialized packaging intensify. The report also notes geopolitics in the background, like the H200 GPU not being sold to China, so routing supply gets trickier.
What's the risk to watch?
Single region concentration means disruptions hit harder, trade rules, capacity constraints, or shocks. The irony is, the more the world depends on Nvidia for compute, the more Nvidia depends on a narrow set of upstream partners. It's a very modern kind of fragility.
Let's do a quick sweep of other stories worth your attention. Start with the OpenAI drama.
Tech Story summarized Elon Musk's 2026 testimony, reported May 3rd, spotlighting the OpenAI schism and interactions with Sam Altman, plus Microsoft's earlier involvement. It's legal and governance heavy, but it keeps pressure on how AI labs explain control, incentives, and investor influence.
Staying in the boardroom, how is AI spending changing deal-making math?
Thomson Reuters Tax reported on May 4th that AI-related spending is complicating M&A accounting. Sellers want to add back AI costs as growth investments when calculating EBITDA, while buyers argue it's ongoing operating expense, directly affecting valuation multiples and earnouts.
And in the real economy, healthcare adoption and big tech moves.
P-Ants reported on May 4th that agentic AI is moving into radiology, cancer care, and admin workflows. Philips calls it a hybrid workforce, with pilots cited at Mount Sinai and Mayo Clinic. WBUR, also May 4th, covered diagnostic AI spreading in clinics. Separately, Yahoo Finance said Apple is weighing a major AI acquisition, still unconfirmed.
Close us out with infrastructure deal flow, what's moving underneath the models.
Digitimes reported on May 5th that Lattice Semiconductor will buy AMI for $1,650,000,000 to boost data center firmware and manageability. Ad Hoc News reported on May 4th that Navitas has a $450 million design win backlog tied to AI data center power, including a custom gallium nitride board designed for Nvidia systems.
That's XPulse AI Morning Mix from XPulse for Tuesday, May 5th, 2026. Share it with someone who'd find it useful. See you next time.